But fundamentally, equities is a non-linear asset class. So there'll be years when you will have negative returns or zero returns. So there can be 3 years where you have zero returns. And then in fourth year, you can generate 60-70% return. And it has happened in the past.
Compounding sounds simple. Stay invested and let time do the work. But in reality, equity markets are non-linear, volatile and unforgiving to impatient investors. Today, I am joined by Shridatta Bhandwaldar, Head of Equities at Canara Robeco Mutual Fund, managing over 1 lakh crore in assets. We talk about what truly drives compounding in India, how he builds portfolios, why chasing returns destroys wealth, and how to separate signal from noise in today's markets. Shridatta, welcome to Gaining Conversations.
Thank you, Ravi, for having me on the show.
This is actually long overdue. I have followed your great work for so long and was waiting to do this podcast with you. And I'm happy that you are here today in my podcast. And welcome.
No, that's very kind of you to actually invite us.
So before we talk about your investing style, I would like to ask you, you studied engineering from Aurangabad. And what was the original career plan when you completed your engineering? And what motivated you to choose a career in investment management?
That's an interesting question. Generally, we don't actually debate these questions now because it's way back these things have happened. But clearly, I think when we were doing engineering, and you would recollect because we're of almost the same age, it was engineering and then job was predominant career, or doing M.Tech or ME was the predominant career path. I never had intended to actually come on the finance side at that point in time. But when I actually did my engineering, while before it I was very fascinated with it, when I did it, I didn't actually like it so much. And that's where I decided to pursue something else which is apart from the technical. Mm-hmm. And that's how I got into MBA, which is MMS Finance from Mumbai University in Sydenham College. Predominant amount of my college days I actually spent, and thankfully our college allowed us to read a lot, spend time in library. And that's where actually initially I picked up interest in the macroeconomic part of the macroeconomics particularly. And then gradually I picked up interest in the financial markets. And that's how actually the journey moved from the engineering, which is technical or doing job immediately, to actually doing finance and then getting into basically financial markets.
Interesting. So how did your background shape how you view investing, risk management, and allocation of capital?
No, I think this is a very pertinent question. And I think your upbringing, your values, your background clearly does impact how you think about investing and capital allocation. And that's where I would go to an extent of saying that it also reflects in relatively more emphasis on risk management, good capital allocation, as well as to some degree little bit of a conservatism when we manage the portfolios at Canara Robeco. And it reflects in how portfolio construction shapes up, how we think about different promoters, how we think about different managements. It is to do with the basic upbringing that basically downside protection is also important.
Completely agree with you. Let's now understand your investing style. So I've been a regular follower of your monthly calls, and I understand you're a great lover of earnings. You like compounding stories. Your core is ROCE and cash flows. Help us understand, how do you put all this into your style of investing framework when you construct portfolios?
I think while on regular conversations, we emphasize a lot on earnings, and that's the most critical part, whether you're talking about the market or whether you're talking about the portfolio or individual stock. It doesn't start there. Fundamentally, it starts at a stage where when you're building the framework, the underlying framework is that the stock is just a ticker. You have to focus on business behind it, and you have to focus on people behind it. Mm-hmm. Okay. And that's where the initial part of any basically due diligence that we do around any new company, new name that is coming in the investment universe, is always around what is the quality of business that we are dealing with, what is the kind of management that we are dealing with, what is the kind of basically balance sheet that we are dealing with. And it is not subjective. When you spend time on these things, we have converted most of these parameters into the ability to statistically quantify and see when we say that this is a good business, does it reflect in its capital efficiency? Does it reflect in its ROCs, ROEs? Does it reflect it in its asset turns? Does it reflect it in value addition in terms of gross margins? So everything around the quality of business and quality of management has been to a great degree converted into financial parameter. And that's where actually the basic framework starts, that you need to have these 2-3 things in place. And once you have these 2-3 things in place, which means effectively you have avoided all the challenges related to weaker balance sheets, avoided challenges related to misallocation by promoters, which means because you are excluding those promoters. Once that happens, and that's where this emphasizes in the regular conversation so much, that within the framework, we have taken out the risk of misallocating capital, aligning ourselves with the weaker set of promoters, avoided the mistake or reduced the mistake of actually aligning ourselves with the weaker businesses. Once that is done, then what becomes critical from a outcome perspective, what becomes critical from a returns perspective, what becomes critical from the near-term and medium-term returns perspective is incremental earnings growth and incremental capital efficiency. And that's where so much of focus when we talk about it, that how the incremental earnings are moving directionally, not for 1 quarter, 2 quarter, but in that business's journey, how do next 2-3 years look like in terms of earnings? How do incremental capital efficiency look like from next 2-3 years perspective? What are the incremental capital allocation decisions that the management would be forced to make basis the incremental cash flows that they have? And are they actually aligned in terms of the interests of minority shareholder to execute that? I think those are the factors where then naturally emphasis come in. And that's why so much of emphasis on that.
Right. When you say risk reward isn't favorable, what specific metrics, flip that switch for you? How do you figure out that?
So I think for us, risk reward is not favorable can mean 2 things. One is, of course, if it is in the bucket where I'm compromising with the quality of business, quality of management, or quality of balance sheet, then clearly I think to start with, your risk reward is unfavorable, irrespective of what statistical valuations that you are looking at, because the business can flip at any point in time, the management can flip at any point in time, the balance sheet is inherently telling you that there are challenges. So that's inherently a odd, whether you say risk reward or whether you say odds, it's a bad odd to start with. That is one bucket. Mm-hmm. Second is, it is acceptable management, acceptable business, and acceptable balance sheet. But then you are clearly seeing that incremental earnings growth for that particular business is decelerating, whereas the valuation for contextual reason continues to go up. And this typically happens in a bullish phase, okay, where the market continues to ignore incremental slowdown in earnings or incremental capital efficiency slowdown, but keeps rewarding it. And then suddenly, when the earnings decelerates too much, then market reacts to it. And that's what I say, that it is a bad or odd, which is not necessarily good. It is a risk reward, which is not necessarily good. While the business is good, the earnings have started turning. And as a portfolio manager, you have to actually manage your weights within that, even if the business is good.
So on that note, is there a difference between a business that grows fast and a business that compounds?
No, I think this is more of a stage rather than basically difference. All businesses go through different stages. There are certain kind of businesses which inherently have ability to initially grow at a very fast pace. The sectors mature and then they become compounding businesses. But they continue to compound because inherently within the sector or within the space, they have some form of competitive advantage. So while the overall opportunity has slowed down in terms of incremental growth, your market share within that doesn't fall, and that's where you continue to compound. So it is just 2 phases. Whereas there are certain sectors, whether they are in terms of just sectors which are evolving new in the economy, or sectors where there is a new guy who has done some disruptions and he's been gaining market share. That is a phase where you get growth. We don't actually tend to differentiate between them as businesses. We tend to differentiate between them more as phases of same businesses, or it can be of different businesses, different sectors. So it is very, very, very specific to sectors and even companies at some point in time.
Okay. Any example?
Like, for example, today, if you look at just Indian economy, and because ours is an Indian context, EMS is a high growth phase. Now, some of these companies might eventually become compounding, But till the time sector itself is growing at 20-25%, most of them will remain in a growth phase. Whereas afterwards they can become basically compounding companies. Whereas you have sectors like FMCG or you have sectors like basically large banks, they will only grow at basically nominal GDP growth plus. They can't suddenly, actually, while the sector is doing well, they are also growing. They can't suddenly start growing at 25-30%. They will grow at probably 12, 13, 14%, which is a little higher than the nominal GDP growth rate. This will remain compounding because they are mature. Okay. Whereas there are sectors like renewables, there are sectors like data centers now. This is just becoming part of the economy. So they are evolving. As they evolve, as they become larger and larger part of the basically ecosystem, there's going to be a phase which is going to be a growth phase. So when we actually construct portfolio also, we typically, in our mind, have very clear distinction that which part of our sectors or companies or portfolio is a growth phase portfolio and which is the part of the portfolio which is more stable, compounding nature. Compounding effectively means those businesses have been there, done that, they have gone through growth phases most of the time, then they have come to a compounding stage, which means they have clearly established the leadership, the competitive advantage, the capital efficiency. So from a portfolio construction perspective, that becomes also your risk mitigation or downside protection sometimes, because that part of the portfolio will always actually ensure that there is no big or disproportionate drawdowns that happens in the portfolio.
So these are basically your mid-sized companies and large-sized companies.
This will be typically, if it's a niche segment of the economy, it can be mid-cap or small-cap also. Yeah. Like for example, there are some chemical companies or there are some basically FMCG companies or there are some basically exchanges or insurance companies which are still mid-size or small size. Whereas predominantly, but a lot of them you will find in larger mid-caps and large caps because inherently the sector has gone through the phase. Right. The sector has matured, the companies have matured, the competitive intensity is established in the sector now.
Earnings are sustainable.
Earnings are typically sustainable at nominal GDP growth rate plus.
Yeah. So you often talk about sustainable earnings compounding. How do you test that durability of that earnings?
So
is the earnings growth cyclical or is it structural?
So fundamentally, let me correct you there. All businesses are cyclical, okay? And thus all earnings will be cyclical. It is just that the businesses which have deep cyclicality will have deep earning cycles, like commodities, like global cyclicals. Okay, they will have huge cyclicality in the earnings. That the earnings can go from 100 to 500, and from 500 it can come back to 100 within a span of 3-4 years. Basis what is happening to that sector. Okay, whereas there are sectors which are inherently in terms of structure, in terms of basically growth rates, are narrow in terms of cycles. So they also have cycles, like FMCG also has cycle, private banks also have cycles, okay, consumer durable also has cycles, retail also has cycle. But typically in a lot of these sectors, the cycles are narrow in terms of the cyclicality. The deep cyclicality is not there, and thus the earnings actually move in a narrow band. So when we say that we are looking for compounding a lot of times, or when we are looking at durable, sustainable earnings, we are not necessarily talking about the same companies at all point in time. We're talking for that from a portfolio construction perspective, that if I have 100 rupees, I want to have 60-70 rupees of that portfolio, where at any given point in time, that 70% of the portfolio in terms of earnings, I have a relatively decent visibility for next 3-5 years. And it doesn't mean everybody will actually deliver on that. It also doesn't mean everybody will fail on that. But as a bucket, that 70% across sectors, across companies should have the visibility of compounding at a certain rate. And that's when we say that, okay, this is the compounding part of the portfolio where we think that the earnings will be sustainable. And then there is a part of the portfolio where we try to create additional alpha, where there could be turnarounds, deep cyclicals and others.
Great. So when you construct a portfolio, what earns a stock the right to become the top 5 position in your portfolio? I'm asking biggest bets. What has to get ticked for you to become the biggest bets?
As I said, as a process, we have ticked on the quality of business management and balance sheet. So what becomes critical for the active weight to be among the top 5 or top 7 or top 10 is basically the superiority of the earnings growth that particular sector or company can display over next 3 years. Because, and why I'm again and again saying next 3 years is because at any given point in time, the best that you can have visibility on a rolling basis is next 3 years, and you have to continue with that process. Some sectors actually continue to do well for 10 years, but at any given point in time, you only have visibility on next 2-3 years. And that's what you actually look at, that do I have superiority of the earnings growth and superiority of the capital efficiency, which is basically superior ROCs in place for next visible period. And that's what makes it to the top 5, 7 active bets, 10 active bets.
So when the growth visibility is strong and valuations look stretched, how do you resolve that internal conflict?
So there is no conflict there. Fundamentally, you keep looking at every quarter whether the thesis
Is
working or not. If there is a change in thesis, the first leg of action that you take is you adjust the weights. So because these are good businesses, they are growing at a faster pace. Of course, they will trade at a premium valuations on an average. But if what is expected out of that business or sector is not getting actually delivered, then naturally you have to act on it. So typically, my sequence of action always is that you start with a certain weight. If the valuation keeps increasing without any challenges in earnings, if the earnings are getting upgraded, then no action required. If the valuation really goes into exuberant zone where you think that basically the earnings will not be able to keep pace while the market is rewarding it, the first action is you start trimming it. And the third is basically if the earnings get downgraded, then you trim it basically aggressively and see whether that lack of earnings delivery is for a particular quarter or two, or it is more structural. Because if you don't act, and if it turns out that 3-4 quarters the numbers don't come, then or 6 quarters numbers don't come, you will continue to get impacted. But if you trim, it leaves you scope to actually act on both sides, basis the data that is coming incrementally from that particular business. So that's how we approach the high valuation, high earnings growth stories.
So in your experience of over 19 years, what types of businesses compound best in India? Is it premium consumption? Is it manufacturing, or financial services, or digital, or something else? And why?
I think as a bucket, what has compounded best at aggregate basis. Of course, there are businesses across sectors who do well, but something that is basically either very, very ingrained in the domestic economy with relatively higher ROE, ROCs, which is either consumption value chain or the financial value chain. So those are the two parts where you find a lot of companies have compounded at a rate which is higher than the averages. Okay, that's one. Second is more to do with the opportunity pie. The second set of companies which have actually done very, very well or compounded very, very well in India are the companies who are export companies who are playing on a much larger canvas. So they had a long, and they clearly had a basically advantage of either processes or labor arbitrage, whereby you could keep getting market share, and the market itself is so large, so you could actually compound for 10, 15, 20 years. So predominantly here, your pharma and IT are the two sectors which fall if you look back last 20 years. And I think on export side, inherently the advantage that becomes for compounding that if you have any clear advantage, whether it is scale advantage, whether it is basically labor cost advantage, whether you have process advantage, the global market is so large that once you establish that, you can get a long runway to grow. So that's the exports part of the. So either you need to have a large canvas where you start as a very small player, or you are ingrained into Indian economy like consumption and financials, where you as a basket you are always growing at nominal GDP growth rate. So these are the two ways I look at it. Anything in export side, anything on the basically which is ingrained in the domestic
one. So if we have to look at Indian equities over the next 10 years, what are the two structural drivers that must sustain for earnings compounding to remain intact?
I think the factors would be the same. That you continue to basically need to get to that 9-10% of nominal GDP growth rate. Having said that, I think if you look back last 20, 25, 30 years, you clearly had a combination of like what we discussed in the previous question also, financialization of economy, consumerization of economy, as well as one or two large segments which became integral part of the global export ecosystem, which is IT and pharma. So it led to a lot of economic activity expansion. When I look at it from next 10 years perspective, some of them will continue to be in the same shape as they have been. Like, for example, financializations or the financial ecosystem will continue to add to the overall economic activity. The consumption part of the economy will continue to remain as it is as your per capita income increases. But I think what is very, very critical is that we get to a situation where we can develop more and more ecosystem around deploying the kind of population that we have. Because we need jobs, we need manufacturing, or we need exports. If not that, we need innovation. So either you do innovation and move up the value chain, or you do basically create a lot of low-end jobs and become manufacturing hub. I think either of them has to be done at $4 trillion to sustain that kind of nominal GDP growth rate and continue to grow at that pace. Otherwise, generally, I wouldn't be surprised if we slow down a little bit from where we were in the previous 10, 15, 20 years.
Let me shift my questions to compounding truths. Most investors think compounding is about time, and you managed money through cycles. What do you think compounding is actually about?
Actually, compounding is, along with, of course, is about time, but more than time, it is about actually keeping that patience and sustaining through the non-linearity that comes in market. Most of the time, generically, when we talk about compounding, we talk as if it's a linear asset class.
True.
But fundamentally, equities is a non-linear asset class. So there will be years when you will have negative returns or zero returns. So there can be 3 years where you have zero returns. And then in fourth year, you can generate 60-70% return. And it has happened in the past. So non-linearity is something that investors need to appreciate when they think about compounding. Clearly, I think. And second is, of course, for that non-linearity to be sustained or to be absorbed, investors need to have patience. So I read that compounding more as your ability to have patience to see through that non-linearity.
So that you think that's the most misunderstood aspect of compounding?
Possibly, yes, because most of the people very easily talk compounding as if the compounding is going to be, say, 12, 13, 14% every year. It's never 12, 13, 14% every year. Actually, I can give you earnings example for that, because market compounds when the earnings are compounding. And earnings are non-linear. So if you just look at last 15 years, between 13 to 20, India had 7-8% earnings growth. Between 20 to 24, we have 18-19% CAGR earnings growth. Last 2 years, we again had just 5% of earnings CAGR, roughly. That tells you that if the earnings are non-linear, your outcomes are going to be non-linear.
Non-linear.
But when you actually stay put, you keep the patience and go through that non-linearity in any bucket of 5-10 years, then suddenly it starts looking at a very, very linear outcome in terms of the compounding.
What do you think about one behavior that silently destroys this compounding for retail investors?
Chasing returns.
Chasing returns,
because people always get impatient. What they have, they don't appreciate. And what is going up today, they always appreciate it and they chase it. So invariably, because there is a earning cycle, there is a performance cycle, there is asset class cycle, most of the retail investors end up chasing and buying it at a point in time where actually you're virtually destroying your outcomes, because invariably if every asset class or every fund, if you buy on the wrong side of the odds, then you are going to get actually below average returns, not above average returns. And I think that we see on a sustained basis. Just look at last 2 years. I mean, you don't have to go back in far. In 24, part of 25, I think a lot of fund managers kept suggesting that basically, and even we suggested that basically there's a clear exuberance in the valuations of broader market, mid cap and small caps. Please be careful, because your odds are not to make higher returns. There's nothing wrong. If you hold on for 10 years, you'll still make probably relatively respectable double-digit returns. But people were looking at somebody else's or past returns of 2-3 years and saying, okay, 25% is the CAGR. But your odds were completely against you. I think the same thing today I'm seeing in precious metals, where people are actually chasing it when I look at last month's number.
So During euphoric phases, what keeps you disciplined? I know you partly answered that question.
No, I think what keeps us disciplined is to keep looking at the fundamentals. Because stock price is something that is not in your control. Millions of different sets of investors are deciding stock prices daily in short term. So in short term, stock prices don't tell you anything about the business, about the management. In long term, the stock prices tell you exactly what the business is, exactly what the management is. And that's why in exuberant phases, if the underlying business fundamentals are not keeping pace, then you know that basically from a shorter term perspective, market is actually diverging with the fundamentals, and that keeps you in check. So I think going back to fundamentals and always looking at the fundamentals, and particularly earnings and earnings context and possibility of what kind of earnings are likely to come and what is the base rate of that particular business. It's like if you're a FMCG company, unless you have some dramatic product, you're going to grow at 10%, 12% max. And if your size, you can't grow at 25% CAGR. But if it grows at 25% CAGR for 1 year and people start extrapolating it, then you know that actually significant deviation is happening from fundamentals.
So when you read macro headlines, I know we are in a world of constant macro headlines. Which indicators are noise and which are signals for you?
I think fundamentally what is happening on the monetary side, fiscal side, are good signals, whether it is local or global. What is happening on geopolitics sometimes, in terms of the broader trend, not what is happening today, is a good signal. But beyond that, tracking every macro news, I think doesn't actually add to anything in terms of your decision making. So yes, we focus on for example, because if I give example, it will become more clearer. Where government is spending its money every year. What is the trend? Is it spending on investment part, capital expenditure, whether it is spending on revenue expenditure?
That's a signal for you.
That's a signal. Yeah. Because that you can actually then drill down to investment part of the economy or consumption part of the economy and can see whether it is translating into bottom up. Similarly, on global front, there was an ecosystem which was established and which was working smoothly. Now, as a trend, it is breaking because of the US administration. Now you know that it has repercussions. So if you think about those repercussions, okay, on a broad basis, and what does it mean for equity as an asset class and what does it mean for you as a country, then it helps. But just reading what Trump said today and immediately reacting on it, I think that's more of a noise because that can change tomorrow. So on global front today, US is trying to reduce the trade deficit is a signal.
Yeah.
When they reduce trade deficit, which means the globe will not be able to export so much. So that's a clear signal. But a lot of else is noise. The US is clearly moving the word to multipolar world, whereby everybody would be on their own. And in that word, thankfully, we are, from a defense perspective, are very, very not so much dependent on a lot of people like Europe or some of the other countries, is a good situation to be in. In fact, it could be an opportunity for a sector like defense. So the macro, when you think about them as theses and come to inferences which are more structural, then it can be used in decision making. Else, a lot of stuff is just noise because it changes every third day.
True, agree with that. So let's move outside of markets. What do you do that has nothing to do with the markets but makes you a better investor? What habit or interest makes you a better investor?
Yeah, I think I play badminton and I listen to music. Both of them actually, I feel, one calms you down.
Yeah.
The other one actually makes you agile. And both those qualities are actually required when you actually manage portfolios. Because sometimes you need to be a little more objective and calm about the situations. Sometimes you really need to be agile. And I think both playing a competitive sport as well as just listening to soothing music, both of them actually, first they disconnect you from the daily grind, and second, they make you actually a better individual to face the decision making phase when things either go bad or go too right.
That's a lovely choice of things to do. If a young investor wants to think like a fund manager, what should they study beyond finance?
I think the one thing that they clearly need to study is when people study finance, typically, and I observe it all the time when new joinees come, junior people join in the team at analyst level, because they are like non-finance people effectively, or non-investment people, is that people look at business in isolation and the Excel and financials in isolation. And I think integrating them and trying to actually look at finance as if it is telling you about the business, I think that is the part that a lot of young budding investors and whoever wants to be serious investors actually need to do. Because a lot of time people feel that, okay, I'll understand business only if I go to their plant, and that's not true. Okay, you'll understand a lot of business if you understand how the P&L and the basically balance sheet is working. What is the asset turn of a business will tell you a lot about business. What is working capital of a business will tell you a lot about business. What is actually happening with the inventory within the same sector? If a particular company has higher inventory days, somebody else has lower. So integrating and looking at the learning of finance as not only learning of finance but also of businesses. And then going and actually checking whether the businesses happen that way when they are meeting management, or whether they are actually doing channel checks or doing the plant visits. I think that can always make you a better investor, because it helps you to develop a framework around that business, the manifestation of which is actually there in financial numbers. Every time company reports the numbers, so suddenly if you see numbers which are moving in a particular way, you know what is happening in the business.
Ground checks are important.
Ground checks are important. So I think that's one thing people need to know. Second is, I think, reading of history of a lot of businesses and general financial history of last 30, 40, 50 years, 100 years will immensely help somebody who's serious about actually kind of delving deep.
So you mentioned about reading. So let me ask you, what books would you recommend for me and for my audience?
Sure. Nowadays, though, I get less time to read, but try to keep up.
Any
but
books which influenced
I think
your...
2 or 3 books which have really influenced, and all of them are actually not very complicated book. I think Thinking Fast, Thinking Slow by Daniel Kahneman. That is one good book. Then the book, Little Book That Builds Wealth by Pat Dorsey, I think is another book that's very interesting. It tells you about the importance of basically quality of business, quality of management, and capital efficiency for investor. And the third book, if at all I have to say, then it'll be basically that Your Money, Your Brain, some US author. So I think these are the 3 books that I would recommend. One is about, basically the first one is Thinking Fast, Thinking Slow, is about basically the second level thinking, that don't go by what somebody is telling you, just try to go to second derivative, third derivative. The book That Builds Wealth, I clearly told you that it is about appreciation of quality of business and quality of management, and its reflection in the stock prices over a period of time, how it has happened. And Your Money, Your Brain is actually talks about the behavior of individuals towards money, and how basically neuroplasticity can happen, where you can actually over a period of time learn to change your habits about money.
That's interesting recommendations. Thank you, Sri. And so I have one last question. So if you had to write one rule for long-term equity investors in India, what would it be? Just one rule,
Focus a lot more on equity allocation. I think that's the rule people need to follow, because people spend too much of a time in trying to understand whether the timing is right, whether the macro is right, what is happening to inflation, what is happening to this, what is happening to global factors. And they forget that they don't focus on how much of my money is allocated in asset class, which historically over last 30 years has given double the basically inflation returns. And I think that's one rule everybody needs to follow, that you focus on your equity allocation And if I have to add, because you have given me only one option, but if I have to add, I think second is when you allocate, focus more on broader odds. When the market is disappointed, try to allocate as much as possible, while it is psychologically very difficult, because your margin of safety is more.
Be greedy when others are fearful.
When basically more and more people are getting exuberant, you don't actually need to increase allocation necessarily at that point in time. So I think these are the two things which, if retail investor or general investor keeps in mind, you would outdo probably half the fund managers by doing that. Just that.
Words of wisdom. So that's quite fascinating. Thank you, Sri, for being so generous with your time.
Thank you, Ravi, for having us.
If there's one theme that stood out today, it's the compounding is not linear and it demands patience. Markets will test you, earnings will move in cycles, but discipline, fundamentals, and resisting the urge to chase returns, that's what separates wealth creators from wealth destroyers. Thank you, Shridatta, for sharing your insights. And to our listeners, stay patient, stay disciplined, and let earnings do the heavy lifting. If you enjoy this conversation, do check our previous podcast. You can find those on Apple Podcasts, Spotify, YouTube. I am Ravi Kumar. You've been listening to Gaining Conversations.